is like, let's say you're handling 1 CR to, let's say, 1,000 CR or 10,000 CR. What is the perspective that gets shifted?
That leads to all kinds of problems. Zomato, Paytm, Nykaa, when they fall in 50-60% of their IPO prices, right? And that is where our RMS keeps all of this open for an investor who wants to know. It helps ensure that our private bankers will only recommend stuff that makes sense. How do you analyze the pedigree of an AMC, pedigree of a team? How do you analyze longer term performance? How do you analyze a market cycle? Whether this market cycle is right or not? That is our responsibility. It is
Exactly.
very easy to raise money when you launch a thematic fund at the top of a theme. Very, very difficult to perform. At IME, for when we launched IME Digital Disruption, we took the polar opposite view. You can then focus on what is right for the investor, not what is right for sales, not what is right for your targets. But you do need the investor to understand certain basics so that they don't get taken for right.
Hey guys, welcome back to Beyond the Bullpen. Today I have Mr. Ashi Anand, the founder and CEO of IME Capital, one of India's most consistently top ranked fund managers over the past 2 decades. After steering from deep value from healthcare portfolios at ICICI Pru, Kotak, and Allegro, Ashi has now moved on from big brand AMCs to build something entirely new, a research first tech driven wealth platform that puts every investment rationale in the hands of every end of the at the end of the every investor. So the platform that IME Capital has initiated is called Research Management Solutions, a cloud app that strips out the usual layers of opacity and lets the clients see the same rating notes and central research desk notes that's used to make these calls. Now, today we'll find out how Mr. Rashi is disrupting the wealth management industry, and we'll explore his journey and some challenges that he has seen and some myths that will break and uncover things that why is it he's so passionate and dedicated to disrupting the traditional finance industry. So let's dive in. Hello, Mr. Ashi. How are you?
Hey Sanjot, hi. Doing very well. Thank you so much for having me on the show. Looking forward to our conversation.
Mr. Ashi, tell me something about our listeners and everyone listening to this. How has been your journey? Where did you begin? What actually got you into finance first, and what was that one enabler जिसकी वजह से आपको लगा कि I should get into finance?
Okay, sure. So actually, what drove me to finance at the first place was this is back in college. I was a maths major, but they had an economic kind of honors program, which was a part-time kind of program at Xavier's Bombay.
Right.
As part of that program, you had to kind of create certain papers and actually present them. And
Right.
I had written a paper on the Asian currency crisis. And
Okay.
just as while doing research into the whole Asian currency crisis, that whole evolution of how the crisis actually came about, because the Asian tigers at that point in time before the crisis were considered some of the fastest growing economies in the world. They were doing exceedingly well. And for
Right.
them to be able to collapse kind of virtually overnight, and the kind of ecosystem that kind of caused that particular problem, the fundamental problems or the fundamental errors that some of these economies and kind of companies in these economies made.
Right.
Basically, over leveraged on foreign currency borrowing, giving extremely high sensitivity to the kind of currency rate. That entire kind of that entire kind of event and the kind of work I did into that really made me this entire space seem extremely kind of exciting, and which
Right.
is very much from college itself. I was extremely clear that not
Right.
only
Right.
did I
Right.
want to get into finance, but I was clear that I wanted to work in the field of investments.
So, Mr. Ashi, tell me something. I'm just trying to be, candid by asking you. जब आप college में थे, did you ever think that you would be a fund manager, or was it an aspiration that you would be a fund manager? Like, how was it, or did it play out by itself?
So at least by the time I was in my MBA, I think the path towards fund management was something which was exceedingly clear to me. As in, it's something it's the
Amazing.
one thing which I was very, very interested in, and I was very sure that this is the career I wanted to choose. I was amongst the toppers in my MBA. I was the head of the
Wow.
finance association. But at the time of placements, there were actually no jobs in the equity markets. This is back in 2002. at a time of an extreme bear market, and really no one was hiring.
The tech bubble, I mean, tech bubble, right? During that time.
Yes. So this was immediately post, right? So
Right.
what happened is that I actually chose to walk out of placements, left campus without a job. I was jobless for the next 3 or 4 months
Okay.
because I was so exceedingly clear that there were other finance jobs available. I could have worked in a bank, I could have worked in other kind of places, but I was clear that I didn't want to waste time in another career. That I This is the place I wanted to be in, and which is why I actually took that fairly aggressive decision, and it really did pay off quite well.
Of course, I mean, you have worked at so many fund houses, but tell me also something, you know, isme, how much of a role did you have a mentor? Did you had someone to teach you along the way, handhold you? How was it like? Because, it's a new market, it's a new industry. I'm assuming, safe assuming that no one from your family must have also been in finance. So, was there anyone who had always helped you, and how much of, of that journey is also part of their teachings?
So while I am very thankful and grateful to a lot of people that I have worked for, and I've had the pleasure of interacting with some extremely bright minds in the industry through my career, I think just very clearly at an early age, Shehzad Madon, my first boss at
Mm.
ICICI PMS,
Mhm.
he really gave me a tremendous amount of exposure at a very early age. At Pro ICICI PMS, not only did I get into fund management really quite early, 2 years out of B school, I was an assistant fund manager, helping manage specific funds. But I
Right.
was also kind of responsible for launching India's first arbitrage fund, the first capital protection fund, a combination of kind of fixed income and derivatives, and also capital guaranteed structure. Now, all of this was really kind of possible because one, Shehzad really did one believe in me. He would push me very aggressively, and thankfully, I was able to kind of deliver. But
Right.
he was just a very, very supportive kind of boss at that point in time, and a lot of the initial growth that I was lucky to have in the industry was I can really thank him quite clearly. The other two people I would definitely like to speak about is this
Ji.
is again back at Pro ICICI, Aniket Inamdar and Tahir Badshah. The
Oh,
three of us were the core fund managers at Pro
right.
ICICI back then, and three of us worked as a very, very close, tight-knit team.
Acha.
Both Tahir and Aniket were like 5, 10 years my senior, right?
Right.
But I think the way that we worked as a team was just very, very well, and there was just a tremendous amount of learning that one had at a very early age, which really helped
Right.
my career quite a lot, and very
Right.
thankful to all of them.
So, a huge shout out to them for creating, the person and the acumen that you have today. But, interesting चीज मुझे इसमें ये पूछनी है. From the funds that you had started to, manage versus the funds you moved on to your career to manage. Let's say, I don't want to put an absolute amount. We can put an absolute amount. You can help me in the answer. Is like, let's say you are handling 1 CR to, let's say, 1,000 CR or 10,000 CR. What is the perspective that gets shifted, and what is like the risk taking ability or the acumen, or what goes into it, into the mindset, into the thought process? I'm not talking about the research itself, because it requires you to change as a person also, right? So what are your thoughts on that journey of moving up the ladder that way?
Sanjit, so actually, quite interestingly, right, the first fund I ever managed, the deep value strategy.
Right.
This was actually a strategy that was launched as a bespoke portfolio for one of our clients at Pro SSA, who
Right.
specifically wanted a deep value portfolio. He didn't want the standard product that we had. He was very interested in value as an investment concept. And because it was a customized portfolio for a particular investor, Shehzad actually helped me effectively allowed me to actually drive a large part of the investment decisions back then.
Right.
Now, this started as a 50 lakh customized portfolio for a particular investor. But
Right.
because performance was so strong, we actually ended up launching it as a product. And the product scaled very, very rapidly. So we started what was a 50 lakh portfolio in a 4 year period, scaled to over 500 crores. And
Right.
this is back in kind of 2005, 2006, when 500 crores was a very large fund. Today, 500
Huge.
crores is really not that large.
Yeah.
We
Right.
actually delivered a 63% annualized return on
Wow.
this particular portfolio. It was the third best performing fund out of 250 funds in existence over that particular period. Now, the interesting part is that honestly, nothing much really changes in terms of the way a fund manager looks at managing a fund when it's 50 lakh, 5 crore, 50 crore, or 500 crore,
Hmm.
right? So the investment philosophy broadly remains the same, right? So that was a deep value portfolio. We were focusing on identifying of great deep value opportunities.
Hmm.
We were a concentrated portfolio. So regardless of whether it's a 50 lakh portfolio or 50 crore or 500 crore portfolio, we were kind of limiting ourselves to between 20 to 25 companies. You are, regardless of whether you're managing small or large amounts of money, you do have to kind of be looking at the entire universe. So to a large extent, a lot actually remains the same. The one big difference is really just from a risk control perspective. When you are managing, say, a 50 lakh portfolio and you want to buy 10% of your portfolio in a particular company, that is 5 lakhs. It's just very easy to go out and execute that particular trade. When it's a 500 crore portfolio, you're buying 50 crores, buying into a new company. One, it actually excludes a lot of the much smaller companies. You do have to be aware about impact cost. You have to be aware of the percentage of holding that you're buying into the company and other such matters. But really, the core of fund management, which is identifying companies, being on top of the entire universe, having a particular investment philosophy that you're following,
Hmm.
building a portfolio construction, with the exception of sizing of the portfolio and risk control with relation to that. The job of the fund manager honestly remains quite the same. I would actually argue that the larger the portfolio at some level, the job becomes a bit easier because a lot of the
Hmm.
smaller companies can no longer be considered. And you actually end up focusing more on larger companies with much better institutional equity, research coverage, much better access, typically governed better. So
So
it is a slightly weird kind of a thing, right? As in where the role doesn't change
exactly,
that much.
because yeah, but also, but don't the stakes get higher? Like, the stakes are higher, but so even a 5% dip or 3% dip does that not add pressure? I'm just trying to understand from your thought process. How is it like? Because there are real bigger funds at stake, right? So how does that work?
So I think this is probably true for most fund managers.
Right.
The way we look at it, we've got a portfolio. You have to
Hmm.
maximize the value on the portfolio.
Right.
And the various things that go into fund management, and they kind of remain, like I said, the same 50 lakhs, 100 crores, 500 crores. If you start thinking about the quantums involved, right, at the age of 25, 26, I was sitting and moving 50, 100 crores in a
Wow.
day, right? Now, if you start thinking about the quantums involved, it actually be very, very difficult to do your job. The job of
Hmm.
a fund manager is you sit, right? You have a
Hmm.
particular
Hmm.
investment philosophy,
Hmm.
you have certain portfolio construction principles. You sit and you
Hmm.
follow that, regardless of whether you're managing 500 crores, $1 billion, or $10 billion.
Hmm.
If you start really thinking about sums involved in all of that, this industry is probably not for you, as in it's.
Fair, fair, fair. Absolutely. So, towards becoming the fund manager, and this is right before we started with IME Capital, towards in that entire journey, any, tough investments calls that we can share, and what are the principles that you had followed to make those tough calls, because, that is what's crucial sometimes that needs to be done, I'm assuming from your position.
So I think the one important element, right? And I believe, so I'm a very strong believer in this fiduciary responsibility of
Right.
the investments industry.
Right.
I think the one very important principle is that you cannot deviate from the fund's investment philosophy and the portfolio construction that you've marketed the fund with. And unfortunately, we do see a lot of deviations in reality in the market. But I think the one core principle is that be it at True, be it at Kotak, be it at Allegro. I've run and I've managed quite differentiated strategies. At True, it was a deep value portfolio. At Kotak, we were actually managing a quasi private equity strategy. It was
Hmm.
a private equity type fund structure, but that would invest only in listed equities. Completely different from what we were doing at True. This was
Right.
a closed-ended fund. We did not have the right to trade. We had to go through an investment committee comprising three of the senior most members at Kotak. The due diligence process into each investment was extremely long, but you were still kind of trying to you kind of had to manage that particular thing. And then I moved to Allegro and I was managing a healthcare strategy. I think the one first element is that you need to be very clear about the strategy that you've launched and why this is something that can generate value for investors. The second kind of element is never kind of Warren Buffett had this kind of rule of investing, right? Rule number one, don't lose money. Rule number two, don't forget rule number one.
Right.
Um, there are very often in the investments industry certain investment opportunities that seem very attractive, very sexy, but they
Right.
come with a high level of risk. Over the longer term, you kind of learn that you try to avoid these because as long as you are consistently delivering returns for investors, that is what investors truly actually do want. Trying to be the kind of hero and kind of outperform significantly, but then kind of losing investor capital. That is something I think most larger seasoned fund managers have kind of realized that that is not the appropriate approach. And ultimately, if you're just coming down to it, regardless of the company, regardless of the philosophy, uh, it has always been a fundamental long-term buy and hold approach towards the way I look at investing is you are kind of buying a small stake into certain businesses and really
Right.
then piggy banking on their growth, right? So, for
Mm-hmm.
example, we hold a lot of Zomato. Zomato is
Mm-hmm.
growing extremely hard. People at
Right.
Zomato are kind of working very hard to actually deliver that
Right.
growth. Our fund and our investors are actually benefiting of that, right? That's the kind of
Right.
ultimate thing that we're trying to do. We try to identify companies that have either the growth potential or
Right.
companies which are not valued accordingly. Because ultimately, share price growth is only going to happen because of either one earnings growth or because of an improvement in valuations. And that's what we're seeking to try to find.
So, I believe speaking of Zomato, let's move to a bit of, PMS, that you have. From the fund manager position that we had, moving on to PMS, how much of, extra added, fiduciary responsibility that came on? What is the kind of research that went in, that we want to look at these sectors because you predominantly look at tech-enabled companies. So what was that thought process? What was that added responsibility that came on to us, when we started a PMS? And before actually placing those bets, what is the kind of work that went into it? That is what, wanted to know because it's a because what the reason why I'm asking is because it paid off. One of these bets, they paid off and they paid off really well. And I want to accredit you that success. So, but for that success, how much of work that went in, and that is what, wanted to know.
Sure. Firstly, thanks a lot for thing, but I think the two or three elements here.
Right,
At the first level, right, is the fact that as a fund manager, I have the ability to launch my own fund. We
right,
also run IME Capital, which is a wealth management firm. And
right,
out there, one of the things that we talk about when we're looking at kind of fund selection is a clear preference towards owner-manager fund structures.
right.
And simple reality of fund management is that when you are working for a larger financial institution,
Mm-hmm.
there are a lot of kind of dynamics at play, right? There are CIOs that you kind of report into, and the CIOs kind of come and go. There is a change that kind of can happen in the investment team. There are a lot of dynamics around sales and marketing and various other aspects. And I think by and large, most high quality fund managers would prefer having their own fund because every fund manager would have their own style. And at some level, you can't be completely true to your own style when you are working in a larger institution where different dynamics kind of come at play. I think the first kind of really interesting thing about launching our own PMS is there is a particular method, way that we look at investing. When I launch my own PMS, the entire kind of institution can be focused around that particular style of investing. What does tend to happen in a larger, say, for example, in an ICICI Pru or Kotak, like when you're working with a large mutual fund, there you're managing there's a large cap fund being managed, a small cap fund being managed. flexi cap fund being managed. During result season, what results do you discuss in the morning meeting? Is it Infosys or is it the small cap? Is it a Scient? Right?
Mm.
There is a level of focus that an owner manager alternative structure like a PMS can afford. That simply doesn't exist in a larger financial institution. I think
Mm.
this is first kind of that's the first important element. Now, when you're talking about the success that we've had with our strategy, which is the IME Digital Disruption PMS, I think this strategy at the time when we launched it would not have been possible in a larger financial institution. What
Mm.
happens when it comes to thematic funds, and if you just look at how thematic funds are launched in the industry, they tend to be launched when a theme is extremely hot, when it is very strong in market favor, when everyone's talking about it, everyone's excited about it. Typically, this theme has already generated very attractive returns over the last 2 to 3 years, and which is why everyone's so hot on that particular theme. It is
Right.
very easy to raise money when you launch a thematic fund at the top of a theme. Very, very difficult to perform. Right
Right.
now at IME, for when we launched IME Digital Disruption, we took the polar opposite view. We actually launched this strategy in Feb 23. This was a
Mm.
time when the Nasdaq had corrected significantly. All your digital platforms in India had kind of fallen 40, 50, 60% from the IPO prices. People were questioning the very viability of all of these businesses. There was absolute panic and bloodshed on the street with relation to such digital names. It really allowed us to buy into these companies at substantial discounts. But what happens is when you launch a fund at such a time, it is actually very difficult to raise money
Right.
because people don't believe in the theme. But that is,
Mm.
a lot of investing is contra. So I
Mm.
think that because it was my own firm, because you can then focus on what is right for the investor, not what is right for sales, not what is right for your targets. We were very clear that these companies have a tremendous amount of long-term value. The sharp kind of corrections provided an extremely attractive entry point from a longer-term perspective. And we actually
Mm.
launched the fund in Feb 23. We almost got the bottom, which is actually quite interesting. Very rarely in market
Mm.
timing as spot on as we did in
Mm.
case of IMA Digital. I think it was more luck than actual timing. We didn't expect these companies to turn around as rapidly as they did.
Right. Right.
We believed profitability would improve. They actually surpassed even our quite optimistic assumptions. And we actually managed to double investors' money in a year and a half since launch. I think
Wow.
speaking as of today, we're probably amongst the top 10 funds in India in the PMS space. But that is, that really comes from kind of a deeper understanding of when's the right time to launch a fund and having a kind of a institutional ecosystem which allows you to launch the fund at that time, right? And that's really where I give you that whole initial part about the owner manager PMS structure because it really helps
Mm.
ensure that decisions are made from an investments as compared to a sales perspective.
Now, here's where it's interesting for me, right? Since you said, I'm trying to get a bit deeper on this, is that you said that tech, sorry, we are going towards a tech perspective where you start placing bets on tech. But when you're working at AMCs, you said it would not work at traditional AMCs, right? Such bets. So, um, please correct me if I'm wrong anywhere, right? Traditionally, it would not work at AMCs, but these were the bets you took when you started your own PMS. Now, in this, yeah, please go ahead. You're saying something.
Sorry, just to clarify, it's not that a tech fund cannot be launched in an AMC, and very often they are. There are, in fact, two other
Okay,
tech funds currently in the market launched by larger AMCs. The
right.
ability to launch a thematic fund when everyone hates that theme and no one is
Mm.
interested, that is
Mm.
something very difficult in a larger financial institution.
So in this exactly, तो यही मुझे यही pulse पकड़ना था, but I would just could not frame it into the language. The idea is that I'm not going to use the word rebelliousness, but that boldness, that braveness, that bravado exists, right? So, what is it that you saw differently? I'm not talking about, so you have accredited that success to luck, but it's easy to say luck, but you had seen something that others didn't. What was that? That is what I wanted to understand. The different kind of thinking that came into play.
Sanjot, so honestly, I wouldn't use any of those terms on myself, right? I believe I'm someone who's exceedingly conservative, right? And
Right, right, right.
right,
It's
it's
I
fine to
understand these
kind
words are
of
very extreme, but
right.
it's
Yeah.
just to see things differently. You need
No,
something,
yeah,
right?
so it's actually about seeing things differently, right? Because see, honestly, the way I look at it, when you can
Right,
buy into companies like a Zomato, a Paytm, a Nykaa, when they've fallen 50-60% off their IPO prices, right?
right,
We have a very, very deep understanding, and we have done a tremendous amount of research into how these business models run. Before we launched the fund, not only had we spoken to the companies, but we had also spoken to a lot of people outside the company ecosystem, but who are part
right,
of this digital space, right? To really understand the thinking and the rationale around how these companies run, why there's such aggressive losses in the near term, why they become very valuable as time goes on. We've seen something very, very similarly happen in the US. Most digital platforms in India are doing nothing but following the same digital playbook, kind of, which has been written by the Amazons, the Googles, the Facebooks, etc. of the world, right? We've seen how they invested upfront to kind of create a certain amount of scale in the business, get users onto their platform. And once you've achieved a particular level of stability, you could shift your focus towards monetization, leading to very attractive kind of profit growth and the emergence of very large companies. There were a lot of things which were very, very evident to us. And the reason I said I won't use the words like bravado or risk taking,
right, right.
honestly, we found it as a very clear bet, right? As in, how could you
Hmm.
go wrong? There was no lack of understanding in our minds around the
Hmm.
fact that these companies had raised more than enough capital to turn profitable.
Hmm.
We were clear about the path to profitability. If
Right,
you go into the kind of individual cost line structures of each of these companies, you could
right.
very clearly attribute specific cost structures that were linked to this hyper growth phase, which aren't required as you kind of start focusing on monetization. We believe there were very strong competitive barriers to entry, which allowed these companies to actually start putting on user fees of all types, launch new areas of monetization, reduce costs as they start shifting the focus towards monetization. Honestly, it was a bet that was exceedingly clear to us. And which is
Hmm.
where, at least from my mind, there was no bravado, there was no risk of launching such a strategy. It was just
Right.
something which was very, very clearly there to make money off.
Now, tell me something within this. I have another, much more finance kind of a question. If we look at the shareholdings of these companies, if you look at it, and traditional Indian companies जो list होती है, if you look at the JSWs of the world or the Tata Steels of the world, it's much more promoter driven, promoter backed. Or we're not even talking about the groups. Let's look at Adani also. The Indian ecosystem of the markets is much more promoter driven. But where we have these, when we have these, tech companies coming into play, the promoter percentage is less than 2%. And this is the same concept which is in the West, where it's much more PE based, PE backed, VC backed, sovereign fund backed. How do you see this culture evolving? Because now there are so many companies that are wanting to list these tech enabled companies. How do you see that culture changing, or and do you see any perspective from a fund manager's point of view changing? Because now that there are you know much more, I'm not going to say, so I think the better word would be people from our community, finance community, which is fund managers, being part of that board which is taking calls. So how do you see that entire structure changing of looking at a company as a whole?
So it's interesting, and there are kind of pros and cons. Firstly, in terms of why the structure, right, where promoters own very
Yes.
small percentages of the overall company. I think this needs to be looked at the context of the kind of sheer hyper growth that these companies have and the kind of hyper growth these companies have been able to deliver. What you have seen is that across kind of digital platforms, you've actually had companies build in years what has taken traditional businesses decades to kind of build out, right? And we've
Yes.
got some of this in our kind of we've got some of this in our pitch deck. If you're seeing Paytm when they launched their kind of lending business, they
Right.
actually in 2 years were dispersing. as much as an SBI cards, and SBI cards took 25 years to build out that level of scale. They
Insane.
were actually in the second year of their loan dispersal, were dispersing more than City Union Bank, which is a century old financial institution. You've seen this. This is not just a Paytm, right? You've seen this with a Nika. You've seen this with a delivery. You've seen this with the Zomato. The kind of what these digital platforms are really doing is using institutional capital to significantly shorten the time it takes to build a large scalable business. And we are talking about crunching what takes decades and decades down to a few years.
Hmm.
Now, in order to do this, the promoter does really have to actively dilute, because before you become a multi-billion-dollar company, you are sitting trying to go out and raise a few $100 million, etc. That can only come if you are diluting. But what this does actually enable is that most of these companies have been able to professionalize significantly earlier than your traditional kind of promoter businesses. There are still businesses that we evaluate today in the non-tech space that even 40, 50 years down the line still are extremely promoter dependent, and these companies even 40, 50 years into their maturity really struggle to professionalize. The
Hmm.
one big positive with most digital tech firms is that the level of professionalization that we see tend to mirror that of really large companies, and this does actually reduce some of the risk of a bad promoter.
Hmm.
That said, you also lose the kind of charm of a really high quality promoter.
Hmm.
Sometimes, if there's a really high quality promoter with significant skin in the game, driving the overall business, may believe that that promoter has a greater ability to drive long-term value than, say, a professional. With a high quality professional, there's always a risk of that professional getting poached, and then you have to
Hmm.
find other high quality talent. We really look at this in terms of both the pros and the cons. We are very well aware that the promoter does not have significant skin in the game, but for most companies that we consider as part of the portfolio, these are companies that we believe have been institutionalized to a level that even if the promoter were no longer around or no longer actively involved in day-to-day management of the businesses would actually continue to run perfectly fine and continue to scale the way they are.
Interesting, interesting. So how do you see that culture change then? Tomorrow, more companies. So this will act as an enabler and a multiplier effect. And more companies would want to do something like this, where they scale fast, they dilute fast, and then they list fast. Is that something that you see? But at the end of the day, the stakeholders of the which are the investors, would not. I'm not talking about the insti ones, but I'm talking about the ones who do not fall into the shareholding pattern. Won't they be the one who would be slightly at a cliff where at the end of the day it's the greater fool theory, right? You're passing the buck to the next person. So don't you think so at that there will be a point where stakeholders are at risk, where they are holding something that is much more expensive than it actually should be, and just become an long term investor, quote unquote, till the profitability comes, if you get what I'm trying to say?
You know, Sujit, I get exactly what you're trying to say, right? And if you just look at the kind of the venture capital funding ecosystem over the last
Right.
5 or 7 years, it had gone crazy, right?
Hmm.
There were HNIs and ultra HNIs that I believe had absolutely no capability of doing unlisted transactions. They
Hmm.
had no ability to assess the deals, legal due diligence was compromised, all kinds of just basic hygiene checks that
Hmm.
even a basic institutional fund would do, right? You were significant sums of money were getting invested in unlisted without any of that happening. Uh, it is important to understand that, from the position where I'm sitting and the fund I'm managing, the IME Digital Disruption Fund, this is a listed digital platform. We are actually having the ability to choose amongst what we believe to be the winners. But the
Right.
simple reality is that when you're looking at the digital tech space and you're looking at the startup ecosystem, there is a extremely high failure rate. The
Hmm.
last decade, because of a certain level of what I believe to be almost mania around kind of unlisted transactions, valuations had gotten crazy and people were no longer focusing on building businesses. People were focusing on raising this round of capital and being able to demonstrate value creation to be able to raise the next round at a higher price. There were
Right.
a lot of businesses coming in without unit economics being clearly established, without the path to profitability being clearly established. right?
Right.
Without the competitive barriers to entry, the particular company's right to win. There's a tremendous amount. When you look at companies like a Zomato, or Paytm, or Nykaa, these are companies that have been able to kind of go through significant challenges and actually emerge victorious. And our fund really just bets on piggy banking on these victorious kind of these companies that have actually been able to scale, do very well, and where we believe there's still a tremendous amount of scalability going forward and still a
I
lot
think
of
this is
growth.
where we were talking about.
But
Sorry, please go ahead. I was just trying to
yeah, go
add some.
on.
So thing is, I was just trying to add to something that you said. This is where we were also speaking, the other day, where we have to model till FY32, and that is where we look at the company and then really look at it from a 6 year perspective for the profitability and then discount it back to its value today. Isn't that another way to look at things? Just wait it out because the profit is not there.
No, so see, yeah, no, but what happens is that the 9 out of 10 companies may not achieve that profit.
Right.
Right. So you have to be very, very clear. So we've got a very, very rigorous kind of a fund selection methodology
Hmm.
at kind of for the IME digital distribution portfolio. There are specific, like, so just to kind of one, we want to be very, very clear about the longer term scalability of that particular opportunity. There needs to be that evidence of dominance. Most digital platform businesses will kind of move towards a tight duopoly, 2 or 3 or 4 player ecosystem. And this is
Right.
because naturally platform businesses, participants on the platform all gravitate towards where there is scale.
Hmm.
You want to ensure that you are going to be one of those winners. So if you're looking at a kind of a fund selection methodology, that evidence of domination, the large addressable market, the path to profitability being very evident, and evidence of kind of optionality to add on new business lines to kind of create incremental value. These are all extremely important. There are about 25 to 30 companies that are listed today that kind of form what kind of we would call digitally native, digital first platform businesses. Only about 7 of them meet these criteria. Right.
Okay.
So when I'm saying we are sitting and we are building long-term models and we are kind of assessing profitability going into FY30, FY32, you can do that for companies where you have that confidence on the growth on the path to profitability. And importantly, the competitive barrier to entry that prevents someone else coming in and actually stealing the opportunity that you work so hard
Hmm.
for.
Hmm.
Uh,
Hmm. Hmm.
so the only way, according to me, to value a company, and we were also discussing this the other day, right? That people look at price to sales or price to users or different kind of
Correct.
metrics to sit and try to assess the value of a company that doesn't make profits as of today.
Right.
All of these are basically just de facto alternatives for a traditional PE, a traditional kind of a profit-based multiple. And
Hmm.
whenever you are using such a metric, it always has to go back to some back of the envelope calculation of what do you think the inherent longer term profitability of that business is. So, for
Right.
example, when Swiggy or Zomato, so say for example, when a Zomato went in for an IPO, right, and they were probably trading at about 10 times price to sales. If you
Correct.
believe the longer term EBITDA margin on that business is about 20%,
Right.
uh, I may be saying, okay, I'm buying it at 10 times sales, but at the back of my head, you're like, okay, fine, if sales is $1 billion and therefore $200 million is the potential longer term EBITDA on this level of sales, you're actually paying the equivalent to 50 EV EBITDA at the time when it turns profitable. And then you're really focusing on two elements that one, what is the level of confidence that you have that these companies are going to turn profitable, right? Because a lot of these are things you're trying to forecast into the future. And secondly, then for that level of kind of profitability, what's the level of valuations that I'm paying? And by buying in today, am I going to be able to kind of create value over the longer term?
Insane. So before we, I want to talk about, what IME Capital is doing, but before that, I want to ask a very left field question to you, right? What is something you must have been seeing a lot of these young kids now starting with their own funds, they're starting with their own family offices, PMSs. आपको क्या लगता है what is the one thing that they're missing out, and is it something that do you need, a plethora? Is it now much more of a knowledge game, information game? What is the bet also, younger kids are playing at versus, seasoned fund managers are then starting their fund 15, 20 years. So what is that delta over there? How is the difference in perspective you feel, or what is it that they are missing out on, or they don't know the traps of it when starting their own funds?
No, no. A lot of people underestimate just the sheer level of complexity that goes into fund management.
Hmm.
There is the extent to which you need to understand. You don't need to understand one company. You need to understand the entire your universe of investable options. This
Right.
actually requires a fund manager needs to be able to have an understanding of what's happening in the IT sector, what's happening in
Hmm.
pharma, what's happening in real estate, what's happening, and you need to have an understanding of not just what's happening in that underlying kind of sector, but how something happening in an altogether separate sector may have an impact on that sector. Simple example, right? Steel prices move up. It's going to increase the costs of an auto manufacturer. Movement in interest rates somewhere else in the world could have an implication on interest rates in India. The amount of dynamics that you have to be on top of just to understand a particular company and to therefore understand. So even if you've understood now a company, right, to a great company may be a horrible stock to own simply because of valuations have gone out of whack. And I think Asian Paints is an excellent example of the same. The
Hmm.
great company, just valuations had gone tremendously expensive, and you're just one position to kind of go into a slightly more competitive environment. Uh, at the first level, evaluation of stocks is something which I think takes a minimum of 10 to 15 years working full time, access to kind of
Wow.
institutional research, right? To be able to really understand this whole nuance around identifying the right kind of company to kind of buy.
Can you
And this is just one.
maybe can you please, so I'm sorry to, this thing, but I would like some color on that. You said 10 to 15 years of institutional research. When we're talking about such depth, what would be the different thing? If you could just add that flavor and just continue your answer, I would love to hear that.
So it's probably a bit difficult to say, but any sector, any company that you go into, it takes a certain amount of time and tracking that sector and those that company to really understand what is happening. And every sector, every company would have its nuance. If you're
Hmm.
looking at kind of banks or NBFCs, for example, virtually no fund managers look at them on a price to earnings basis. You always
Of
use
course.
a price to book, right? And
Correct.
there's a particular reason why you do so.
Correct.
If you are kind of looking at an IT services company, right? And now you may have an IT services company trading at 25 times, which is dependent on kind of US demand. How do you compare that to, say, for example, a capital goods company in India, which is trading at 30, 35 times? There is a lot of elements around, there are so many financial ratios that are there, right? There's an EBITDA margin, there's an ROE, an ROC, kind of
Correct.
working capital cycles, the specific ratios that you focus more on in one industry versus another,
Hmm.
right? Why are you looking at this and why are you looking at something else there?
Hmm.
We all have heard about forensic accounting, right? How do you sit
Right.
and identify that there's something inherently wrong happening with a particular company? Uh,
Hmm.
there are so many elements that go into understanding this. And honestly, as an institutional fund manager, you are a bit spoiled because you have the advantage of the institutional equity broking or the equity research ecosystem where you
Hmm.
have kind of, so as an institutional fund manager, I can pick up the phone and talk to someone who spent the last 2, 3 decades only focusing on analyzing a particular sector, right? Or
Insane.
2 or 3 sectors at max. And you actually rely a lot on this ecosystem to be able to understand some of these nuances and build it out. Uh,
Hmm.
Having sat on this side of the table, right? When I see people who are kind of doing investing part time, they've got an altogether other job and they're kind of buying on tips, they're buying on someone's told me to buy this. I saw this company, I like this company. Um, Honestly, that is speculation, right? It works and it works brilliantly well in a bull market. In fact, in my experience, in a strong bull market, your retail investor would actually outperform fund managers such as myself because we have too much gray hair. we are too scared to kind of do certain things that
Right, right,
versus
right,
someone who's new actually be
right,
happy to do, and these work well in the bull market.
right,
But it just it's such a nuanced subject, and this is just understanding a company.
right.
Portfolio construction, right? Number of companies, how to diversify, optimal levels of diversification, liquidity control, multiple other elements that go into how to construct a portfolio.
Hmm,
The optimal level of diversification can significantly reduce risk without impacting returns, right? And
hmm,
that is actually the golden mean. Now,
hmm.
all of these are so highly nuanced. Honestly, fund management is a lot more complex than being a hairdresser or being a car mechanic.
Right.
Yet, the number of friends I know who would never cut their own hair, who would never repair their own car, but they're all
Hmm.
managing their own portfolios, right? So,
Right, right.
it's not advisable according to me, but you still have a lot of people out there going out and doing it.
Exactly. So that is why I wanted to ask. A lot of young people are starting this now. Coming to, this is where, we enter into the segment of democratization. And before we delve into it, one small question also. How do you look at democratization from AI perspective? Because now that this institutional research is, on the tip of everyone's fingers using chat GPTs of the world and other AIs which are upcoming. Don't you think so? This kind of services that, are now getting on the tips of, people's fingers and everything. So how do you see that as a threat for institutional guys also?
So at some point in time, right, I think a lot of us are going to be jobless, right, as AI becomes more and more advanced. Uh,
Right.
Honestly, it's a difficult question to answer because see, it's the point is that it's not access to information, it's what you do with information. Uh,
Ah,
Now, the first point is that even access to information, most institutional research that I'm talking about,
right,
right, is very closely guarded amongst it's within the institutional community. Your
right.
retail investor and a public kind of a bot like a chat GPT doesn't have access to this information. So AI won't necessarily have access to that information until some of these institutional equity firms actually launch their own AIs.
Mm,
So
mhm,
now the second element is this whole nuance of how do you sit and basis information, what you do with it, and what kind of portfolio do you construct.
mm,
There are over 250 PMS firms out there, right? There are a bunch of mutual funds. You see two mutual fund portfolios, you'd see differences. People have access to similar institutional research, but they are taking different decisions. So, what do you do with that information now? Would AI be able to do a better job than a fund manager in terms of constructing a portfolio basis that information? I would argue in the future, probably yes.
mm.
I'm hoping that happens when I'm 60 and I'm due to retire. But we are nowhere close to that at this point in time,
Right,
right? But as AI becomes more and more sophisticated, the whole see what is a fund manager's role, right? You are sitting, you are looking at a very large amount of disparate information, trying to
right.
understand trends within that to be able to try to forecast the future to understand what companies to invest in.
Mm, mm, mm.
AI has arguably the ability to understand and comprehend a larger amount of information than any fund manager can.
Right.
Now, then comes that nuance of can the AI there, then having looked at all this information, can they technically construct a better portfolio?
Mm.
There are enough quant guys out there who believe that this will be possible. I'm sure it will be, but there is some time before we reach that point.
I hope is when you reach 60 or 65, and then
Yep,
not anytime soon.
I
Right.
would very much hope so too.
So coming to the theme of democratization, let's talk about your passion project. And this is something that, I also want to talk about. But it's just that I wanted to, have ourselves some context and a base of, our discussion before we moved into, something that even I want to know so much about. Um, Mr. Ashi, tell me something about what have you seen in the wealth management industry? And I'm not saying from the perspective of revolutionizing it, but what are the, things that have gone wrong that you have seen that has led you to feel an aha moment that, what, maybe I could do something different. Maybe I could, use my core value of fiduciary responsibility to bring in something different. So essentially wanted to know what were the things that you have seen, gone wrong with people, or some incidents, or some, I don't know, it could be anything that you feel like sharing. We would want to know that you felt that you could bring in something new.
So, yeah, thanks a lot for getting asking that question because this is something very, very close to my heart. I don't think that's an aha movement. It's a kind of realization that has just grown over a period of time. And this is not something that just I feel. I know every fund manager feels this.
Hmm.
As a fund manager, there's a particular fund that I'm managing. I ultimately want the investors who are investing in my fund to actually make returns.
Hmm.
Now, in order for investors to come in and have a good experience investing in our fund, uh, uh, you actually need two things. One, you need the investor to understand what it is that they're investing in. If you invest in a fund without having understood what that fund is about, very often when things may not go right, you may not have the ability to actually hold on, right? Or you've come in with a different expectation, the fund does something else, and you actually exit too early, and they all kinds of. So an investor needs to understand what they're investing in. The second thing is that while we all say you shouldn't try to time the markets, when it is important that you're getting into the right fund at the right time.
Hmm.
There's a right time to invest in digital stocks. There is a right time to invest in pharma. There's a right time to invest in large caps. There's a right time to invest in small caps. The simple reality is, in my kind of 2.5 decades of managing funds,
Hmm.
uh, the amount of times I've actually interacted with an investor who's invested in a fund, right? And very often investors are investing in our funds without talking to the fund management team. They're talking to the private bankers, the wealth management firms, etc., who've come into the fund with an altogether wrong understanding of what that fund is. And very often the fund doesn't make sense for that investor in the context of what they want. So, for example, through ICICI, I used to run a dividend yield portfolio.
Hmm.
This was considered to be a low risk, low return portfolio.
Hmm.
However, because at the time when we had launched this fund, a lot of dividend yields were actually available in the PSU space, in your oil and gas refining companies, in your PSU banks, other such plays. Uh, and this was back in 2003, just before the kind of as in before a lot of new regulations came in. The Surface Act had come in. There was oil and gas deregulation that actually drove a lot of value creation in these companies.
Right.
Because of that, this fund had actually done exceedingly well. And a lot of investors came in expecting it to be an aggressive high risk fund. Look, absolutely contrary to what the fund is trying to do.
Hmm. Hmm.
In Kotak, we had a 5-year lock in fund, quasi private equity style. Someone had gone and sold, and this is Kotak was an international fund. Someone had sold this fund to someone, a 92-year-old gentleman. I am
Hmm.
aware of a multi billionaire without any heirs to the throne, who's actually
Hmm.
been sold a 5 crore life insurance product.
Insane.
Absolutely no kind of relevance, right?
Hmm. And
Now
all that is
that is the
because of
first
why their
problem. The
commissions were attached to it. All that because the
so
commissions are
I'll so
attached.
I'll just
Is
so
self-interest
so
attached?
yeah it's not just commission. So I'll just get to that, but let me just cover
Sure.
the second big
Sure.
problem there.
Please go
So
ahead.
one
Yeah.
is
Yeah.
getting into the fund at the wrong time. So
Right.
getting into the wrong fund with the wrong expectation. Secondly, is you understand the fund, but you just got into it at the wrong time. What
Hmm.
tends to happen is that investors chase trailing returns.
Hmm.
So kind So as I was indicating, very often, and we see this in small caps especially, you get money after a theme has run.
Right.
The perfect time to invest in small caps would have been in 2014. The bulk of the
Hmm.
investments happened in 2017, 2018, the absolute wrong time.
Hmm.
Now, this is something which has always personally impacted me, and I know it personally impacts all fund managers.
Hmm.
Uh, because you get the bulk of your money at the wrong time, and you'd have funds where the fund may have delivered a 25% long-term annualized return or 20% long-term annualized return. But if you
Right.
actually see the average return for the investors, it may be low single digits because it's all coming in at the wrong time. And this really kind of hurts as a fund manager that if you're not being able to ultimately deliver returns to your end investor, right? One is your NAV and how the fund is performed, but you ultimately want your investors to make money.
Right.
Now, why does this happen, right? And I think commissions and conflicts are part of the problem. But there is, if you just understand how information is going down to the end investor in
Right.
the investments industry, it is actually a multi-layered form of communication. There's a fund manager who actually knows what fund they're managing, what that fund does. You
Right.
then kind of go to the wealth management industry where there's a central product team that does due diligence into these funds and identifies what funds to kind of onboard onto their platform.
Right.
This is a team of research people. They then decide to onboard certain funds onto their platform, and then you get to the private bankers who are then trained about what this fund does. The private banker is ultimately a salesperson who comes from a non investment background, who is there because they have selling and client relationship skills, aren't there because of their great investment skills.
Right.
They are very often just trained on how to sell a fund without really understanding the nuances of how that fund operates.
Hmm.
And the end investor is ultimately dependent on this private banker who himself is not an investment professional. And the two of them are sitting and trying to take a decision on where to allocate money.
Hmm.
Now, by the time information and insights is reaching the end investor, you've gone through Chinese whispers of four different layers of communication. There
Hmm.
are known conflicts of interest, there are commission biases. You have questions of competence when it comes to slightly more complex funds. The moment you get into something in the unlisted space, if you get into something using derivatives, the vast majority of private bankers themselves don't really understand what's happening in these funds. You have an issue of RM biases, RM dependence, and you have a very important sales agenda.
Hmm.
Uh, the discussion the private banker and the investors having is actually one of sales, where the private banker is trying to sell a fund to the investor. It is
Right.
not, it may be positioned as investment advice, but ultimately, if you look at the reality of the market, you have a bunch of sophisticated salespeople going out and trying to sell funds. It is a lot easier to sell a fund which has been outperforming for the last 3 or 5 years, even if it has kind of no longer there's no longer value in that particular theme.
Hmm.
It is a lot easier selling a flavor of the moment fund. The kind of focus shifts away from what is right towards what can sell. And the entire kind of wealth management ecosystem that I've seen in India is really positioned quite strongly towards what is easier to sell. And
Hmm.
without getting too much into specifics, but time and time again, I've kind of seen kind of financial firms sometimes take decisions driven more by something being easier to sell than being actually right for the investor.
Hmm. Hmm. Hmm.
Now, this happens because information and insights are being driven or delivered by someone with a sales agenda. And I
Hmm.
think that is a fundamental flaw. This multi layered flow of communication is something which, by definition, according to me, is almost designed to fail in
Hmm.
terms of achieving the requirements for the end investor. And which is where, right now, I've complained about this, and me and fellow fund managers, when they speak, we all are aware about this problem. We all discuss it in great depth. I think finally, about 5 years ago, I kind of said that, enough time complaining. It's
Hmm.
time to start sitting and trying to, as compared to just complaining about problem, try becoming a solution to the problem.
Right.
And which is where really IME Capital was created.
Hmm.
The idea behind IME Capital is actually setting up the first wealth management firm in India with a very, very distinct positioning of being a research first wealth management firm.
Mm-hmm.
Our entire first 2.5 years was spent on just kind of becoming thought leaders in the space in terms of really getting the research rigor that I'm aware of that exists in institutional asset management companies, and using that same rigor that I as a fund manager used to evaluate sectors and kind of companies towards evaluating funds.
So,
And on
sorry, here I want to, push a bit things on, deep dive a bit. When we talk about, you said research, how are we researching and what is the differentiating factor in our research?
So I think there are a couple. So if you ask me, the one big competitive advantage we have at IME Capital
Exactly.
is that uh, so the research team is actually headed by me. I'm a
Right.
fund manager evaluating other fund managers.
Right.
There are a lot of nuances of fund management that I can tell you the central product teams of the largest wealth management firms in the country don't necessarily appreciate. If you look at the central research team of any wealth management firm, you will normally find this comprising kind of people who come from a products background, who have never actually managed money themselves. I can tell you that a smart fund manager who's good at communicating can kind of communicate whatever he wants to some of these teams. And they really, because they've not worked as part in that role, it's not as easy for them to really understand what's real versus what's not. There's another intrinsic advantage that fund management is a very, very small community. There are probably some 200, 250 senior fund managers in the industry, especially senior fund managers, probably even less.
Mm.
The vast majority of the senior fund managers have all entered the industry 20, 30 years back.
Correct.
All of us were going, descending on the same broker conferences, sitting in the same kind of company meetings. There are these small group meetings that happens with corporates. So a lot of these are kind of immediate peers. Our ability to sit and understand what a particular fund is doing versus the other, right? That is something which is, I think, a clear competitive advantage. Um, Now, that is effectively that I think is something that we have that most other kind of firms would not. Now, when it comes to analyzing the fund, there is a very clear methodology that we have around how do you really evaluate a fund, right? And how do you identify what fund, the five large cap funds or five flexi cap funds, how do you identify one being better than the other? As a
Right.
fund manager, I understand the ecosystem that allows one fund, the same fund manager in one organization versus another type of an organization would actually perform quite differently. There
Hmm.
are certain enabling ecosystems, there's certain elements that are required for longer term success.
Can
And
you
we
tell
really
me?
understand the nuances of this.
So, in within these nuances, maybe let's take a case study and help me understand how would you, let's say I have a corpus of 3 crores and I came to you, right? How would you place me? What would be the process that I would go through with you? And which is different than, how an institution or someone else would be seeing, and how it really would you, help me evaluate, or you would evaluate for that matter, differently than another fund manager. So what is that evaluation process with the, corpus of that investor cup when it comes to you?
Okay, Sanjot, before I get to that, let me just explain
Sure,
one key thing before I get to that.
sure,
Right. So
please.
the first differentiator at AMI Capital would be our depth of expertise with this very clear
Sure.
research first positioning. There is no value having great expertise at some central team level if
Right,
that expertise is not available to the end investor, right?
right.
And that I think is the biggest disruption we have caused, and that's the biggest disruption at AMI Capital, which is the
Hmm.
use of technology, where we literally open out our central research database into funds. How we
Mm-hmm.
have sat, we've sat and we've rated and ranked all
Right.
the mutual funds, over 250 PMS firms, some 300, 400 PMS schemes. We've looked at AIFs. Those central insights of our central research team have been documented on a technology platform called the IME RMS.
So is that your tech stack?
And that is our tech stack, right?
Okay.
And that is something which our investors get direct access to. When
Okay.
we document our insights, we are very particular about documenting insights in a manner which
Okay.
is easy for an end investor to understand.
Hmm.
And investors have direct access to the central research team's documentation. There is
Mm-hmm.
no other wealth management firm in the country that opens up or is as transparent. Everyone has a shortlisted list of funds. But why those funds have been shortlisted? What was the thinking? If I've sat and evaluated one FlexiCap fund and given it a 5-star rating, another fund a 3-star rating, another fund a 1-star rating, we have looked at 5 specific criteria when we've looked at these funds.
Right.
Our thinking on each of these criteria for each of these funds is available on our tech platform directly for our end investor to be able to open and see. Now, the reason for that is that as a fund manager, if I'm trying to build a wealth management firm, I obviously can't access or speak to every one of our investors. It just physically is not possible.
Not scalable.
And which is where you can, it's not scalable, it's not kind of thing, right? As if you're trying to build a larger firm.
Right.
But at IME Capital, no matter how big we become, tomorrow we could be a multi-country kind of, we already are. We have investors from all over the world. Now, the investor who's sitting in Bangalore right next to our headquarters, to the kind of investor in Delhi, to the investor in a small town in India, to an investor in Africa or an investor in the US. Every investor is seeing the same identical view on a fund, which is driven by our central research kind of team. And this is a central research team which is not sales incentivized, is not client facing, who has been basically taught to basically every fund will have some pros and cons. We are absolutely transparent about what we like, what we don't like, and we just write it the way we see it.
Mm.
Now, I think this communication of information, where information and insights are being driven from a research perspective
Right.
as compared to with a sales agenda. This is the huge missing piece of the
Mm.
industry, right?
Mm-hmm.
And we are able to achieve that because all communication on why we like a fund. The investor
Mm.
can see what a central research team who doesn't talk to a client thinks about
Mm.
that fund,
Mm.
right? And I think that is that big kind of real difference. So a second core differentiator at AMI Capital would be around the level of transparency that we operate in. We
Mm.
believe investors need to have a complete perspective on the fund, not just on the pros. They need to understand the cons as well. There are certain AIFs, for example, which seem very attractive until you don't understand the fee structure.
Mm.
On our RMS, we'll talk about the fee structure. If there's a problem with the fee structure, very often there's a problem with something called a catch-up clause.
Okay.
The vast majority of investors may not even understand what the catch-up clause is. But that catch-up clause can take a fee structure of 2.5% and suddenly make it 5%.
Insane.
We will mark this in dark red that here is a problem here. And this is
Mm.
the kind of information which should normally get hidden. So that's
Mm.
really the second kind of core differentiator which actually is there, right? And that's what we're trying to change in the industry. We
Mm.
believe investors have a right to understand the entire perspective about a fund before they take a decision. And if you allow that communication to be driven by someone with a sales agenda, if you allow a private banker to go tell one investor this is a good fund, but the same private banker is going to tell another investor this is a
Mm.
bad fund, right?
Mm.
If you have
Right.
five private bankers, each with their own chosen best funds that they are recommending, none
Right.
of this is the right way for the industry to operate, and this is the reality of what happens in the industry.
Mm.
Right now,
Mm.
that is what we're fundamentally trying to change with this whole kind of RMS, where information is now centralized. Every investor is seeing the same single point of truth, and advice is being driven by people with no sales incentives whatsoever.
Right.
Sanjot, now just coming to your question, right?
I would
What
like to
happens?
change my question because of
Okay, sure,
everything that you have shared. I want to change the question. Abhi, what was the version one of our model, our tech stack, and versus where we are now? What has been that? How big has been that delta since where we began and where we are now?
So Sanjay,
Considering, sorry, considering, I remember us speaking and you said it's completely bootstrapped and without any external funding. So it must have taken a lot of, problem solving, critical thinking, and team effort, and you also, wearing that badge of fiduciary responsibility. And I'm sure there must be a lot of, external concerns is also coming in. So within this entire, story that also you have been that you have, how has the tech stack also improved? So there are a lot of factors that we are playing with here, isn't it?
no, no, and it's been an evolution, right? And it's been a
Right,
long journey. Sanjay, the interesting part is that the entire tech stack that we use
right.
was never actually meant to be used for what it is. This
Hmm.
is actually something I've developed as a fund manager
Hmm.
because I needed a way to be on top of my own research.
Right.
A lot of investors don't, and I would argue a lot of the top management of the largest institutional AMCs in the country also don't really recognize the problem they have around being able to manage and document their research and their insights. What
Hmm.
happens is today, for example, if a Naren were to leave ICICI, you
Hmm.
recently had a Prashant Jain leaving in HDFC.
Hmm.
A lot of his knowledge and his insights and his understanding into why certain companies were bought, a particular investment philosophy tends to leave with him. I can tell you when a new fund manager comes in and has to take over someone else's fund, you're looking at a fund, there are certain companies, what was the thinking behind that company? That effectively gets lost.
Hmm.
Of operating as a fund manager, I felt
That
this
is
need.
where, sorry, that is where there is a, I believe I've saw it in your fund also, in the RMS also. There's a percentage of dependence on the fund manager, 95%, 100%. That's that what the criteria is?
No, so that is something different, right? That's one of the rating criteria.
Okay,
Uh,
okay.
right. But the reason I know the reason that's such an important rating criteria was I know the reality of how these
Right,
funds work,
right,
right? And if the fund
right,
manager leaves, what happens?
right,
Um, I think there's a crying need for institutionalized management of this knowledge.
right.
As a fund manager, I've gone and I've met a company.
Okay,
I go and meet the same company 2 years later.
okay.
Has the management now changed his story? Right?
Hmm.
What did they tell me 2 years ago? What did they tell me a year ago? What did they tell me 6 months ago? What did they tell me today? Um, this is not a problem when you're covering 10 companies.
Hmm.
The average fund manager will be looking at 100, 150, 200 companies. You have
And he
to
has a
have a
team
way
also.
and you have a team, right? So today I've gone met this company. Tomorrow my team member, 6 months later, is going meeting the same company. How does that team member know what this company told me?
Hmm.
Now, this is a big problem I face as a fund manager. And which
Hmm.
is why I've always been interested in technology. And
Hmm.
which is where I had developed my own kind of tech stack, operating as a
Right,
fund manager, to manage
right,
my own research notes and my own research thinking.
right.
Now, and that is really the birth of the RMS.
Hmm.
Now, subsequently, kind of when I was around the time when I was thinking of setting up IME Capital, by then I had a fairly sophisticated research management solution to manage my research and understanding into evaluating companies.
Right.
I realized when I'm talking about this problem in wealth management, the exact same system could be used to evaluate funds.
Hmm.
So the first kind of the original or the genesis of kind of the RMS that we have today at IME Capital
Hmm. Hmm. Hmm.
goes back to my own research technology stack that I developed for myself
Hmm.
to manage my research notes as a equity fund manager. I
Hmm.
realized the same thing could be used for kind of wealth management because it's the same thing. You're evaluating companies, you're evaluating funds, you're evaluating things. You want to see how things are changing over a period of time. It's the same requirement, really. Now, the moment so phase one was really adapting the system towards funds,
Hmm.
also adapting it towards not just a fund manager viewing his own notes, but how do you simplify how you are documenting things to be
Hmm.
able to make it easier for an end investor to So, as I was saying, the first kind of major change was when we had to adapt it to simplify the way we were storing information, to make it easier for an end investor to understand.
Hmm.
For
So would it go, so if you had to put it in like stages, so we started with documentation. From documentation, we went on to which stages to where we are at right now.
So it was documentation of equity shares. How do you adapt that to documentation of funds?
Okay.
Then how that's stage number one. Stage
Correct.
number two is how do you simplify how
Okay.
information is made available so
Okay.
that and a private banker can understand it. In fact,
Right.
in the first 2 3 years of IME Capital, it was meant to be used by a private banker. The
Mm-hmm.
end investor didn't have direct access to it, but the private investor could, banker could download it, share it with discussions with the end investor.
Okay.
The major change that we then had about a year and a half back is when we actually opened the RMS out to the end investor directly.
So the
Now, this has a
stage
lot
was
of
opening it
information that
up.
some
So third stage was
was
opening.
opening it up. Yeah.
Okay. So that is
Uh,
where we are now. So it is like a three-phase journey that you went into, right?
yeah. Then the fourth stage of another last
Correct.
important step
Correct.
was actually making it work in a mobile native format. Right? Because a
Mm-hmm.
lot of investors are comfortable using things on the mobile, but the sheer level of information that you have, right? How do you simplify the way you're displaying that information to still make it work where you can communicate information in a mobile format? I
Right.
think we've been able to, through all these evolutions, we've been
Right.
able to simplify the way we pass on information and insights to a
Hmm.
level where an investor can just look at certain colors and get an indication, right? Of do we
Interesting.
like something, do we not like something? And the whole idea is how seamlessly can you make the transfer of insights from the central research team to the end investor?
Hmm.
And that's really been the kind of various evolutions. From a tech stack perspective, Sanju, the interesting part is we've probably changed our tech stack 3 or 4 times. We
Wow.
keep trying to find slightly better, superior ways of kind from a pure technology perspective, right?
Right.
Of what what's a better format. So we've moved our databases towards more scalable databases. We moved our front-end systems towards more robust systems. We are currently on a tech stack which is amongst the kind of like it's very similar to the tech stack of the largest digital firms in the country. So it's something which is very
Insane.
scalable, very secure, etc. But I
Okay.
think the biggest element is not the technology. The biggest element is the intent and the
Hmm.
desire to keep making information available in a manner that an end investor who's not interested in finance, not interested in investments, has something altogether else on their mind. But how is it that they can know that, yes, this makes sense? The 5 things of the fund, these are the 3 good things, these are the 2 bad things.
Right.
I think we've been able to display information in a manner that that kind of insights can be shared in a matter of kind of 5 10 seconds.
Hmm.
So you're not trying to overwhelm the investor with too much information, but you're giving them access to what's most important.
Every single time when we have a disruption, there is a pushback. Are you seeing any pushback?
So we originally had a lot of so just one minute, Sanjot. Sure. Yeah. Um, the interesting part was we earlier had some pushback because we had made everything public, and
Correct.
we had rated funds. We
Right.
got a lot of pushback from uh, funds that were rated poorly, right?
Right.
And the tough part is some of these are close friends,
Of course.
right? As one pretty
Right.
much knows a large part of the industry.
Of course. Yeah.
Um, So we got that we got quite big negative pushback initially around the fact that how can you publicly rate things like that. We modified things around to be a little more politically correct in terms of at least a public facing language.
Mm-hmm.
Um, Now that was I
Are
think
you
the
guys
probably
still
the
friends?
biggest, sorry.
Are you still friends with those fund managers then? So very
No, no. So
politely
yeah,
since
no,
you
no.
had
So no,
right,
so honestly, it's not been that thing, right? Because we have a very clear and a very transparent rating mechanism.
right.
Some of the kind of funds that had been rated poorly were just because the funds were too nascent, and because we
Mm.
were publicly indicating that the reason for the low rating is we want the
Mm.
fund to mature. We've not seen
Mm.
this fund over a particular investment life cycle.
Right.
There's a fund manager who's done something else in the past, he's doing something else now.
Right.
Right? It's not just you've given a low rating out of nowhere and the person you've rated low doesn't understand why. Right? All of this is available. So I think this was the one pushback that we got. But apart from that, I think the feedback we've got from investors is overwhelmingly positive.
Hmm.
Especially, the larger the investor, there are certain HNIs and ultra HNIs who deal not with just with one wealth manager, but multiple wealth managers. I think the moment they've been exposed to our system and our way of operating, the one big question that we keep getting is, how are you guys able to do this with such a small team, whereas firms much, much bigger than you, right,
Correct.
aren't able to? My simple answer is, if they wanted to, they could. They just, as
Hmm.
in, there are too many negatives from a sales perspective, right? As in,
Right. Right.
a lack of transparency, or transparency is not necessarily good for sales. There's a lot
Hmm.
of things which, so I think that's the main thing we've experienced.
I mean, see, so what we are trying to say, so I mean, I don't, so here's a bit, I'm pushing a bit of the gears. So essentially, when we say, or when we read these fact sheets, or when we read these, some of these funds are saying we are client centric, it's actually, how do you, it's not a definable measure. It's just a statement that we say it's client centricity. But how do you plan to define it or benchmark it? Because there is no way of actually quantifying it. If we can take this opportunity, since with all our tech stack and all the efforts we have taken together, if there was one way, if you could benchmark yourselves and the kind of democratization that we're doing, how do you want to benchmark your client centricity?
Sanjay, so I think the interesting, because every firm, right, wealth management firm will say they have expertise.
Correct.
Everyone will say they're transparent.
Correct.
Everyone will say they're ethical. Everyone will say they're client first,
Correct.
right? And we've had clients ask us exactly this and exactly this kind of language. I've heard this
Yes.
10 times, client first. I've heard this 10 times, right? How are you different? Now, I think that is really where people, the moment they see the RMS, it becomes
Hmm.
blazingly. Now, I'll give you a few examples.
Please.
We sell insurance. We sell insurance across the board via sub-brokers or Policy Bazaar. Every insurance product available can be sold. It is a
Hmm.
well-known fact that commissions in the insurance space are substantially higher, and which is why so much insurance is wrongly sold. We have a public-facing blog that has
Hmm.
in red and green types of life insurance. Term insurance is in a green box saying these are the reasons why term insurance makes sense. But the
Hmm.
moment you get to an endowment plan, a money back policy, a ULIP, we have big red boxes which sit
Hmm.
and indicate these are the problems and these are the reasons that these don't make sense from an investment perspective.
Hmm. 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 Hmm.
This
Hmm.
is an example of kind of advice being driven from research, not from sales.
Hmm.
Another example, right? The moment someone asks us this question, all we do is we can just open up the RMS, and a lot more people are aware about mutual funds as compared to PMSs.
Right.
It's a very well-known fact, not just in investments, in any industry. A smaller, unrecognized firm would have to pay more to distribution than a very large, well-known brand.
Hmm.
We can just sit and look at the firms and look at the way we've rated them. And you see the much larger, much more recognized brands, the firms which have performed a lot stronger, right? All of these have higher ratings. If you go and look at our 1 and 2 star rated funds or firms, these are all firms that are unknown, which haven't been around, don't have as much of a track record. Now, that is where incentives can be much, much higher, right?
Hmm.
You have much lower incentives when you're dealing with these larger. The moment you look at that, it becomes clear.
Hmm.
There now, because of the amount of information that we have, and because of the way that information is being delivered, we
Right.
have 5, 10, 15, 20 ways of being able to substantiate the
Right.
fact that we are actually putting the investor first.
Hmm.
One of the things, Sanjot, about our process, you're asked about, you've got some money, how do we sit and identify the right
Correct.
fund for you?
Right.
Uh, The standard experience in wealth management is you say, I've got 3 crores. The private banker will say, these are these great 5 funds, which are great for you.
Hmm.
We don't, as a practice, get into recommending funds until we're not into our third consultation. The first two consultations are just around trying to understand the investors and the investors'
How about
requirements.
how about let's play this out? Let's make this into a proper example so that we can also understand this, and I also understand this better, versus how a traditional would perform and how we would perform. Let's say I had 3 crores, and how would a traditional, firm, what would be the process like? Could you just walk me through in short, and then, because that would be then a proper benchmark for us to see that, okay, this is how we are doing it differently, and this would also help us understand it. So, what would be a traditional approach, and how is it specifically that we have changed that?
Sure. So, Sanjot, I won't get into the expertise and the
Of course,
transparency that we've already
of course,
discussed.
that we have
Right?
already discussed.
Yeah. I'm only
Yes,
talking about the client journey. Uh,
exactly.
right now, when a client meets a private banker from
Right.
most traditional institutions, very often in the first discussion, you fill out a risk profile.
Mm-hmm.
You'll have a discussion around certain financial goals.
Okay.
You'll have a broad discussion around certain asset classes. And
Right.
very much within that first 1 hour discussion itself,
Mm-hmm.
there would be these are these 4 or 5 funds that are kind of recommended,
Mm.
right? That is the way the industry normally operates.
Right.
We've developed something called the IME investment mandate, which
Mm.
is a very clearly defined process
Mm.
that takes what I know to be best practices of wealth management or private banking from global examples and what is available for ultra high net worth individuals in India. We've taken those best practices, integrated that with some of the best practices of an investment mandate that fund managers use before they launch a fund.
Mm-hmm.
And that is our kind of process of trying to identify what are the best funds for you. You've got 3 crores, you need to invest. I need to have your investment mandate developed in order to be able to accurately answer that question.
Mm.
What goes into the development of an investment mandate?
Right.
There are multiple elements. The
Yes,
first
please.
is the development, and all of this that I'm talking about at IME Capital, we do all of this absolutely free, no commitments whatsoever,
Mm-hmm.
before as part of the kind of initial consultation process.
Right.
So we develop a financial plan for the investor. The financial plan is extremely important because you need to correctly identify the investment horizon of an investor.
Right.
You meet an average investor and you ask them the investment horizon, they'll say 3 to 5 years. You
Right.
build a financial plan, very often you realize that the actual investment horizon is 15 to 20 years. Now, the
Mm.
right investment approach differs very significantly from a 3 year to a 20-year kind of investment horizon. We try to ensure that we have that understanding correct.
Mm.
When we do our risk profiling, the standard industry is you run a risk profiling and you get a risk profile score. There's actually two different risk profiles. There's something called a risk taking ability and there's something called a risk appetite. And these can
Mm.
sometimes be at polar opposites of each other. Someone could
Mm.
have very high risk taking ability, but virtually no risk appetite, or
All
vice
right.
versa. You have to
Right.
understand both of these elements separately, which is what AMI Capital, when we do the risk profiler, we get 2 scores to get to your final score. Now,
Interesting.
the investment horizon helps determine the right asset class. The risk profile helps you determine the right category.
Right.
Now, what very often we've experienced is that investors, the private banker speaking to the investor, getting a few examples, a few understanding, and then saying these are the right funds. We have come across when we're doing the investment mandate, the third part of our investment mandate, which is showcasing to investors the entire investment universe to
Mm.
shortlist the categories that are the best fit for them.
Mm.
That part of the process actually exposes the investor to all the different types of options that exist. In
Mm.
structures, you could invest in a mutual fund, a PMS, and an AIF.
Mm.
When is an AIF better than a PMS? When is a PMS better than a mutual fund? When is a mutual fund better than the other two? Right? There are
Mm.
specific nuances of each of these. Different asset classes, equity, debt, hybrid, global investing. Within equity, sub kind of categories of funds.
Mm.
There are two shortlists for a particular investor. What are those chosen? What are the specific categories that make the most sense? Now, that is what we do as part of investment mandate at IME Capital, which is use the risk profile, use the financial plan, use other preferences and beliefs to actually shortlist from a very large investment universe the specific structures, asset classes, and categories that are relevant for that particular investor. This becomes the mandate. And on the IME RMS app, the moment a mandate is created, there's actually a view where the investor will only see information related to his mandate. So you
Hmm.
aren't getting lost with overwhelming information about funds that have no relevance for you. This process takes about 2 to 3 consultations.
Hmm.
And it's only after you've kind of gone through this 2 or 3 consultations to build out this mandate do we really actually get into, these are the 3 or 4 funds that are relevant. I think it's just a question of attention to detail and really focusing on a more consultative approach towards building on portfolios.
Within this, in our last discussion also we had spoken where, you had said that you'd also want investors to research or have some a bit of knowledge, but, of having funds knowledge or, knowing what funds do and should also have an open eye. But isn't it, I am carefully going to use the word unrealistic from an investor's perspective to know about funds, because eventually that is what I come to you for, isn't it? So, what's your take on that?
Sanjot, two important elements here. Firstly, let
Yes,
me give you the data.
yes, please.
90% plus of our investors probably never go and read our views on our fund,
Right.
right? The RMS helps ensure that our private bankers cannot go and give an investor a contrary view to what research feels,
Hmm.
primarily because there's a advantage of this a sales advantage out there.
Hmm.
Right now, let's just assume one of my private bankers is approaching you. You have an existing portfolio. We'll say
Mm-hmm.
we'll sit and do a portfolio review for you.
Mm-hmm.
There is a clear hidden agenda of that private banker when you're doing a portfolio review to say
Okay.
that your existing portfolio is bad.
Right.
So that your existing advisor is therefore bad and therefore come work with us instead.
Right.
Right now, even if you have a portfolio of absolutely good funds, in the
Mm-hmm.
traditional industry, a private banker can go find problems with these funds and say that these are the reasons why these funds are bad and these are the funds are good.
Hmm.
That is not possible in the IME capital ecosystem.
Hmm.
Because the moment you give a portfolio for review, that portfolio gets uploaded onto the app. You don't need to read our reviews. There's a 5, 4, 3, 2, 1 using colors red, yellow, and green, right? To indicate whether you should go or not go. Are these good or are these not good? Forget the
Right.
whole rationales and all which are all available. So without the investor actually having to himself go in and read about the fund, it helps ensure that you've created an ecosystem that a private banker will only recommend stuff that is of high quality based on research.
Right.
Now, the part, when I said investors need to understand the funds that they're investing in,
Mm-hmm.
I'm not talking about them understanding the nuances that, say, our research team knows and understands. Right? That
Mm-hmm.
is our role. Why are you
Right.
coming to a wealth management firm? If you could do this yourself, why would you pay the higher cost, say, for example, of dealing with a wealth management firm? That is clearly for the wealth management firm and for the private banker to know and understand.
Hmm.
However, an investor needs to understand certain basics about how a fund operates.
Hmm.
In my experience, and it has been remarkable because you see this time and time again in practice. The
Hmm.
average investor would spend more time researching what mobile phone to buy than the
Right.
time they spend building a financial plan. The
Right.
financial plan apps online that sit and help you develop a financial plan in under 3 minutes
Hmm.
takes us an hour and we are very efficient.
Hmm.
But there are nuances, there are those elements. So now what happens is that all investors are sitting and researching a mobile phone to buy. They don't need understand. It's not that they understand, they need to understand the inner workings of how a mobile phone operates.
Hmm.
They have certain requirements. I want a screen size of so much. I want a screen resolution of so much. I want my pictures to be of a certain quality. I want my phone to work slightly fast. Same thing when
Mm.
you're buying a car. You are able to express, an investor understands the difference between an SUV and a sedan and a hatchback, and
Right.
goes into a showroom and doesn't kind of go into a showroom wanting to buy a hatchback but looking at the SUV and test driving the SUV and vice versa.
Mm.
Now, this is something which is lacking when it comes to investments. Investors come to the table, right, without knowing do they want small cap or do they want large cap, and they're letting the private
Exactly.
banker choose. Now, that leads to all kinds of problems. The
Mm.
level of information required, right? There's a certain basic level of understanding that I believe all investors need to know before when they're interacting with the fund manager. That level of information is about half an hour's work to sit
Mm.
and understand some of these basics. We've got something called the Academy. We have an investment options webinar that we conduct that goes into over a half an hour, 1 hour period, right? All the investment options that exist, etc. That basic understanding of how equity works, how debt works, how do you save tax by going to arbitrage as compared to debt. There are a lot of these basics are no different from that basic understanding that investors already kind of subject themselves to when they're buying a mobile phone, buying a car. You go in and do some amount of research. That is what is required. How do you analyze the pedigree of an AMC, pedigree of a team? How do you analyze longer term performance? How do you analyze a market cycle? Whether this market cycle is right or not. That is our responsibility,
Mm.
right? And that is where our RMS keeps all of this open for an investor who wants to know. It helps ensure that our private bankers will only recommend stuff that makes sense. But you do need the investor to understand certain basics so that they don't get taken for a ride. And I
Mm.
think, unfortunately, there's a certain fear of investments. The basic fundamentals of investing are simple enough to teach a 10-year-old,
Mm.
right? And I have time and time again come across investors who've not bothered about that. And again, I believe this is because there is a clear hidden sales agenda of
Mm.
keeping your investors uninformed.
Mhm.
And that is
Mm.
fundamentally what we're trying to change at IME Capital.
Here's where I want to ask you a few, resolution based questions before, our discussion comes to a great conclusion. Is that forget IME Capital, forget your experience also and everything that we are, trying to accomplishment wise, but the momentum that you have built, to pursue this kind of a disruption, just going to coin it as a disruption. Is it coming from passion, idealism, stubbornness, any face setback? So what is it that's driving your, fire? What is your engine like over here, which is giving you that push?
Sanchit, so yeah, the words you use, I think, really are quite bang on, right? As in, it is, I think, firstly, a certain level of idealism. Uh,
Right,
I like for me that fiduciary responsibility when you're managing someone else's wealth.
right.
It's something like it's you put your hand on the Gita, you put the hand on the Bible, or
Ah,
there's a I think it's something very sacred almost. In
mm-hmm.
fact, for me, that is a sacred responsibility.
Right.
People have really worked hard to build their wealth, to get a certain amount of money. For a vast majority of families, how that money is managed helps determine can their children go to get the right education? Can they retire holding their heads up high? Right?
Mm.
These are very, very important. It's a very sacred responsibility
Right,
that as a fund manager, as a wealth manager, you are basically taking on.
right.
This is something I believe I've seen probably being violated. That makes me really angry. And
Mm. Mm.
I want to, whatever I can, I want to do to try to change that.
Mm.
I would personally be extremely happy if all the wealth management firms saw our RMS and copied our RMS and took
Mm.
away our biggest competitive advantage,
Mm-hmm.
right? I've been lucky enough to have generated enough wealth to take care of myself and my family. IME Capital is not about generating personal wealth. That's one of the reasons why we've not gone and raised external capital. One could very easily play the valuation game and all of that, but it's clearly not what the idea is behind IME Capital. There is a strong passion and an ideal that there is a better way for money to be managed. And at least for our set of investors, we believe we already achieved that. And I believe as we grow and as we scale, because we're doing things the right way, the bigger we become, we start becoming a problem for other people in the industry, and they will be forced to adopt some of our practices. That's really what I'm sitting and trying, hoping to be able to achieve.
Yeah, I hope so too, because what we are trying to set out to do is something that is unheard of, and if even if it takes time to achieve that, I think it's worth pursuing because that is something that is for the right cause. I don't want to make it too utopia, or I don't want to make it too idealistic, but it's the right thing to do, like you said. Has there been?
Because,
Yeah,
sorry, just
please.
one thing, I find it so disappointing and unfortunate that we have to call this utopia or idealism. According to me, this is just the basic fundamentals of how the industry should work.
Right,
It is
right,
not utopia.
right,
We've gone so far off what is correct. So just
right,
moving back
right.
to correct is kind of seeming like. So
Right.
sorry, I just had to kind of.
So that's actually a right way to look at it. But has there been, can you tell me once, I've just two questions left, but one of the question I want to really use it towards, has there been any story, any success story from a client that you want to tell me? It could be like he came in and he saw something in terms of performance, or it could be something like he was already with an institution and then he moved his fund to you. Or could you tell me, a little bit of the success story from a actual story perspective that has, made an effect on the people that you have, or the stakeholders that you are trying to contribute towards?
Sure. So, Sanjay, let me give you three short examples. I
Yes,
think the
please.
biggest from a company perspective and what we're trying to build perspective is the fact that as a relatively young firm, we've been
Right.
able to kind of attract HNIs and ultra HNIs who've
Mm-hmm.
come organically to us because they found some content on our website that's not available in other places.
Hmm.
And we've been able to convert without a referral, without any direct connection with that person. We've been able to convert HNIs and ultra HNIs who bank with multiple advisors, who've
Right.
come with us, and a number of them we've been able to actually become the sole advisor for. And
Hmm.
these kind of investors have actually said that they've dealt
Hmm.
with many advisors in the past and they see something so different at Ami Capital. Right now,
Hmm.
that is something which is kind of, and there are multiple such examples. And in fact, the larger the investor, very often the easier it is because of the sheer, they've actually been exposed. We actually had one investor where there was a generational shift happening, a larger kind of a family, bit of a family office kind of a setup, where the father was actually handing over the reins to the son and the daughter to actually take the investment decisions. They were going through detailed due diligence
Hmm.
of all the kind of private banks to determine who's going to be their advisor.
Hmm.
And they had to sit and make the case up to the father to say why this is the chosen one.
Hmm.
They had evaluated every large name in the industry,
Hmm.
and they happened to stumble upon us. And we were speaking to the son, and he kind of said that, every other company that we've looked at is either a very large known brand or is someone who's kind of been directly referred by someone we know and trust. You are new, you are thing, but everything I'm seeing, I'm kind of preferring over the others. But it's such a difficult case to make because you're new, you're younger, and all of that. And the son actually managed to go and convince his father to actually go with us and be other kind of sole advisors. That was actually something quite gratifying because it was a detailed due diligence that they were going through.
Hmm. Hmm.
But Sanjot, by far for me, what for me is the one of the most important stories is money is ultimately meaningless. It is a means to an end. Money
Hmm.
on its own doesn't have value.
Hmm.
It is an ability, money gives you an ability to do certain things you want to in life.
Hmm.
There, one of our investors was running his own business. We sat, and when we started our discussions with him, we really emphasized the importance to de-risk and create a pool of capital available,
Mhm.
which is apart from that of his business, so that if there's a downturn, you have an ability to go through that downturn.
Hmm.
This investor was with, so we did this. This investor started investing with us, was with us for a year, year and a half, and then there was a huge downturn in that person's business. And
Hmm.
this pool of capital that he had actually helped safeguard him through that kind of downturn.
Mhm.
He came back to us and he said, if you guys hadn't pushed so aggressively around this importance of risk mitigation, all the cash flows were going back into funding the business. He's saying, I would have been forced to go back to my father. I would have been forced to either one, quit my business and go back to employment, or go back to my father to ask for money.
Hmm.
To be able to go and in a short period, right, we're a 4-year-old firm, to be able to make a fundamental change in the life of one of our investors. Honestly, that is more gratifying than any 25% versus 20% IRR or those kind of things, right? You're sitting and trying, I think, trying to change lives. Another similar example, very, very rich individual, retired, who was so scared about money that was unable to spend.
Hmm.
We could sit and we could map out and just show that person the amount of wealth that they have, and no matter what they're spending, they're actually going to be fine. For the vast majority of time, you're trying to tell people, listen, save more. Here, this is actually the polar opposite. We were actually telling the person you can spend more.
Hmm.
But when you can go and change the actual life of an investor, as compared to just being able to deliver 1 or 2 or 3 or 4% higher returns, I think that is the most gratifying. And we've had kind of a number of such examples.
And I wish you also more success stories that come along the way. And I think you should have a separate, I would suggest you could also have a podcast with your, some of the clients if they're okay to be on your kind of discussion, which has led them to the success that they have had or whatever journey that they went through, and they have placed their faith in what IMA Capital is trying to do. And this brings me to my last question, and this last question is usually I make it very reflective based. If as a founder of IME Capital, it's a bit, I'm going to push you on the edge with this one. So if they achieve collectively nothing else, what's the one change that you're the most passionate about that you've brought into the world of investing, and what legacy do you hope you leave to your competitors scratching their heads thinking, oh, we missed that?
Very, very simple. Uh, the one change I want is I want investors to be able to access the
Hmm.
right information when they're making an investment decisions. I
Hmm.
want them to be able to understand what they're investing in
Mm-hmm.
and be able to kind of have access to information that's coming to them, which is not being driven by trying to sell them something, but
Hmm.
the reality of the pros and cons. I think investors have a greater ability of being able to understand this phone better meets my requirements than this other phone. This car better meets my requirements than this other car. This house better meets my requirement than this other house. This hotel meets my requirements than this other house.
Hmm.
If I could get investors to not be as afraid about investments
Mm-hmm.
and ensure that they get information in a manner which is
Mm-hmm.
easy for them to digest and understand,
Mm-hmm.
to help them better understand this fund is better for me than the other and therefore make better decisions.
Mm-hmm.
If I can improve this by whatever level, I believe I would have succeeded.
Hmm.
That's the one big change I'm really, really passionate about. And I'm really hoping that whatever we're doing at IME Capital, that we'll be able to help drive at least some of this change.
I think you have all the ingredients as a fund manager, and collectively, all the ingredients for, the purpose that you are trying to pursue. And that is where I also feel that it could, shake some old walls up, and it could shake some old pillars up of these institutions where we are really trying to democratize a traditional way of doing business. And I wish you the great success for IMA Capital and the path that you are on.
Thank you so much, Sanjot. It's been an absolute pleasure having this discussion with you.
Yes, yes. Thank you, Mr. Rashi. And I hope to always, host you eventually, maybe in 6 months' time, and to talk more about your journey and how it has been, how have you added more value, and so that it could be a proper case study also for our listeners and to everyone in the markets of, how transparency is not an utopia, but is actually possible and is actually making difference in people's lives.
Thank you so much. It will be absolutely my pleasure.
Yes, yes. Good day to you and thank you. Thank you, everyone.
Thanks a
Thank you
lot.
for listening. Yes,
Thanks.
yes. Bye.
Thanks, Sanjot.
Yeah. Bye. Bye.